Hi, Sean with you in the early morning hours of Monday, November 17th, taking a look at some of the developments in the global markets and specifically in U.S. equities over the past week and in the week ahead. Specifically, I'm going to talk about automakers briefly, but first I want to take a look at the Fordham Stock Market Challenge, which of course I'm tracking. I haven't actually made any trades, but I'm definitely going to open some positions today if the market conditions are right. But first, I want to point out the Sharpe ratios that some of the contestants are generating here. In terms of the portfolio rankings, we have 32 contestants, 31 actually. After 1 week of trading, the leading rate of return is 1.65%. We've got 5 guys over 1%, and then we've got 10 guys, 13 competitors who are generating negative returns, some as low as 11%. But more interestingly is the Sharpe ratio rankings of the group. Obviously, the Sharpe ratio is a measure of risk-adjusted return, I guess you could say in the most simple terms. But one user has a Sharpe ratio of 13.87. That's ridiculously high. I don't know what he's in. He has to be in mainly cash because his portfolio value has barely nudged up about 1.2%, but still, we also have a ratio of 8.18, 5.58, 2.29. I'm really interested in, how these returns are being generated, because those are just extremely high rates of risk-adjusted return. I'm sure we'll learn more about that as the contest goes on. But specifically, in the markets, I want to talk about automakers a little bit, and I think I'm going to short General Motors today. And this is because it's hovering around $3 a share. In the competition, you can't short stocks that have a value of less than $3 a share, and I think that General Motors is running into significant trouble. It appears from the Obama administration anyway that significant aid to the automakers, U.S. automakers, is not on the way. Of course, there could be larger congressional efforts that force the administration's hands, but right now, I'm not terribly convinced that that's going to happen, at least in the near term, and I think that GM's going to give up significant value as we move ahead. Longer term, I think GM is doomed. They're not going to be able to get the concessions they need in terms of retirement benefits from their workers, from the unions that represent them, and their fundamental philosophy in terms of producing cars is not keeping up in the global economy. They're still producing large SUVs. The GMC is still one of their largest divisions. They need to scrap GMC altogether. They have outdated divisions. They have divisions that have never worked. Brands like Saturn, they need to scrap them completely and start over with smaller, trendier, more efficient vehicles that are providing consumers what they're looking for in 2008, 2009, and into the next decade. Moreover, as time goes on, I'm becoming increasingly doubtful that consumer confidence and general economic trends are going to improve significantly, if at all. In fact, I think they're going to get worse for at least another 12 months, really. And I think that GM simply cannot weather this storm. Their commercial paper is not going to have support in the market. They're going to run out of cash. And I don't know what's going to happen at that point. I really don't. Maybe the government will come in, but they're going to have to make significant concessions, especially in light of what's been developing in terms of congressional reaction to how the TARP/CARP/ Secretary Paulson's discretionary $700 billion have been distributed. One senior senator, Republican senator, said today from Oklahoma that he thinks that Paulson could be giving away money simply to his friends on Wall Street. Obviously, that's not happening in that way, but the fact that there are senators and legislators who believe that is going to result in increased congressional direction in where government monies are going to be directed into the economy, and I think that it's just not going to be easy to get that money into automakers. And as such, GE is not looking good. That's going to be a short. I keep hearing people, pundits, analysts, people who write newsletters, people who show up on CNBC, everyone saying that, reminding us that the stock market often moves ahead of the real economy by 6 to 8 months. I don't know why I keep hearing this, but what's clear is economic data keeps continues to be released and it continues to be negative, and the stock market continues to react negatively. So whether or not we're trading ahead of the real economy or we're trading in sync with it, we still have a lot of ground to give up. Do I think that this means we're going to have 3 consecutive down weeks on the S&P and Dow Jones Industrial Average? No, we could, but I think it means that we're headed towards, we're in a period where you can easily pick stocks and various securities that are going to lose ground consistently over the time ahead. Now, over the weekend, I was perusing selections from regional newspapers, small newspapers from across the United States, and I came upon an interesting article, an interesting column actually, in the Freelance Star, which is a newspaper in Central Virginia. And this was by a columnist there, a local man, who said that he thought unemployment could reach 20% by next year. Now, obviously, we know this is ludicrous, but still, it shows a pretty interesting window into the psyche of many people living in middle America. They think this economy is very bad, and it shows me the consumer confidence is already very low, and general confidence in the economy is going to continue to lower for quite some time. We're going to see a lot of negative sentiment in the market by ordinary people for a long time. As for today, we've seen solid performance so far out of Asia for the most part. It's going to be, who knows how the market's going to open in the United States. We have some interesting economic data coming out just before the opening today. We have the Empire State Manufacturing Survey and industrial production. Everybody knows those numbers aren't going to be very good. If they're terrible, obviously you're going to see the market react more negatively than expected. If they're great, then maybe we'll see a little bounce. But I think the market is going to react to Friday's losses by trading up at some point during the day. I'd say we gain at least 150 points through the day, and I think we give that back. But I think it'll be a high day for volatility, good day for high volatility, if you want to call that good. But I wouldn't be surprised if we end up slightly here today. As a result of just last week being so bad, it's difficult to have such a sustained period of losses. And I think that we're going to see a couple days of gains this week, to say the least. As such, we'll take the heartbeat of the market as it opens up. Hopefully, I still do have those short positions. I'm going to think about unloading them, trying to play the gain that I see coming in, at least intraday, and then maybe closing out, heading into all cash. By the end of the session, we'll see how that works out. As for the stock track, the Fordham University stock picking challenge, I think that I've been considering going into levered short biased ETFs, because I think over the next few weeks we're going to see losses. But you have to remember that when you're investing in leveraged ETFs, they're trying to get a certain percentage of daily returns on whatever the index they track is, and that's a lot different than the long-term returns. Because if you have an ETF that's trying to achieve 200% times the inverse of the S&P 500, if you have a total portfolio value of $100,000 and you give up 10% one day, then that takes your portfolio down to $90,000, and it's going to be much more difficult then to get a value, to gain 10% on your original portfolio, because you've already lost 10. And if you have one or two more bad days in the ultra short, it's through the concept of compounding, it's going to be much more difficult to get your portfolio value up to where you want it to be, even if in the long term we're seeing you have the right predictions about where the index is headed. That said, it could be just bad enough that investing in the levered ETFs over a period of 2, 3, 4 weeks or more, which is a period that I think you have to hold securities for in this contest, could be the way to go. I'm not quite sure about that. But anyway, I'd like to close by saying that I'm planning, I would like to write a piece for Seeking Alpha this week, sort of an analysis piece, something a little bit more intensive, something that provides some actual insight. We'll see if I actually get around to doing that. It's heating up here as the semester winds down at school, but if anything, I'll continue to post little updates like these. Wish me luck, and speak to you soon.